What's up, traders? Today I want to talk about Tesla and how I want to play the stock. It hasn't gotten to the price that I want to buy it yet, but I can still have access to the movement of the stock, make gains on the stock without it getting to that ideal price. The way I'm going to do that is by talking about cash secured puts as a strategy. We'll get into that in just a moment. Let's first look at the current price action. A lot of people on social media have been bragging and patting their backs about capturing some of these gains on this dip buy. That's usually a bearish indicator when people are getting a little too excited. In the longer term trend, Tesla is definitely up. But where I want to buy it is the 50% because that's where I look to do almost all of my trading. And if you go and look at my Apple video, where I looked at Apple over the last 20 years, all the opportunities where in the longer term, sometimes years at a time, it always seemed to pull back to a buying opportunity at 50%. You'll see that even in the highest flying of tech stocks, you can still find these opportunities. What I'd be looking for on Tesla is going from the COVID crash on a pullback to the halfway point, which also just happens to match up with some pretty good price action right in here. So that's going to put the price that I want to buy Tesla at 480, but didn't quite get there last week, and now it's coming off of there. But I would caution people on thinking just yet that this is a run for the high, because just as a 50% can be effective in a buy, you also need to take into consideration where Tesla has come back to and held. Not to say that it's going to be a resistance just yet, but it could be. Either way, I'm not going to really look to buy this until it gets to where I want it. So in the meantime, what can I do? Well, I can look at selling cash secured puts. Let's look at the math on it and explain how it works. So this is a put selling strategy. And the way that you're going to do this is with a strategy called cash secured puts. That means you have to back up your sells with the cash in your account. So you'll need a big account to be able to do this the way that I'm going to present it. You'll need to be able to take on 100 shares of Tesla in order for this to work. So here's an example of a Tesla order right now as I'm making this video. What I'm looking at is the April 16th, 2021 480 put. And right as of making this, you could sell that for a $950 credit or credit $950 if you took it fully to expiration. The max loss, we're going to talk about this in just a second, is what you need to consider because your buying power effect, in other words, if you have a account that will let you take cash secured puts, this is how much you need in your account. Now, this may be a lot for some people. I understand that. But we're going to talk about some other alternatives a little bit later. But I want people to understand how this works because maybe you don't want to do it in Tesla. Maybe you want to do it in another stock. So the math works out this way. If we sold the put, we would get a credit of $950. That means into your account goes a credit. You don't have it yet, but a positive $950. Now, in order to keep that $950, that option needs to expire worthless. And for it to expire worthless, that means that Tesla has to stay above 480 the entire duration. We need to consider what would it take to buy Tesla 100 shares worth, because that's the notional value of an option contract, 100 shares, at $480 per share. Of course, that's going to be $48,000. If we sold that credit and the price of Tesla got to 480 or below at expiration, we would not have to buy all the shares at 480. We would be able to credit against that $48,000 what we received from the put. So we would actually technically get it cheaper. We would only pay about $47,000 for those 100 shares. So there's an added benefit in selling puts that you can actually get them a little bit cheaper by putting this on in this way. But in order for it to be cash secured, the risk is that you have to take on those shares if that put goes in the money. But we already wanted to buy Tesla at $480, didn't we? So we're okay taking it on at that price. That's the key thing that you have to remember. When you're selling these cash secured puts, you're picking a level where I want to buy the stock at anyway, and I'm going to hold that stock till a target or forever, whatever your strategy is on that stock. So you're already comfortable taking it on at that price, even if that price has not happened yet. So that's the mentality that you need to get into when you're thinking about this. Let's see how this plays out if we did this on a regular basis. And again, this is purely hypothetical. And also, this is not financial advice. These numbers I'm going to present are ideal conditions. The stock is going to be volatile. Options are going to change prices. That's just the forewarning. So we're in March right now. And let's say we sell the 480 put, which has about 36 days till expiration, for $950. We'll want to close that not at expiration because there's no need. Usually the premium that we can receive is already expired well before. So either at 75% or at about 15 days till expiration, we want to close that. And hypothetically, we should be able to capture about $712. We also want to close it early. That way we can do it the next month. So we can do this on a monthly basis. So going forward, we do the same put sell, except we do it in the next month, come April. And let's say Tesla has gone up. And so obviously that put is going to be worth a lot less. We're not going to receive as much credit. We're only going to receive, let's say, $650. Do the same thing, close this 75%. We capture a little bit less money, go into the next month. Now Tesla has come back down. It's closer to 40. Let's say it's something like 520 when we put this on, something like last week. This was the price, as you could see. So now we're able to capture more premium, about 14, do the same thing, and we're able to pocket a little bit more. So over these 3 months, we could have received a credit of $2,249. If we take this in relation to our max capital, in other words, the $48,000 that we have to lay out and put on the line, over the quarter, we've actually returned on that capital 4.6%. Now, of course, that doesn't sound like much, but think about it this way. You don't want to buy Tesla just yet, but you have the cash on hand to buy it. So what are you going to do with that cash? Are you going to let it sit in your trading account doing nothing, getting no interest? Are you going to put it in a savings account at very, very small interest and then transfer it when that happens? Or can you benefit from Tesla's movement by selling this against it? So over the course of a year, it's possible that you can make some double-digit return on just your cash waiting to buy Tesla or any other stock at the price that you want it. So instead of letting that cash just sit and do nothing, once a month, you can go in and sell the puts at the price you want those shares and capture a little bit of return on your capital for it just sitting there. Let's use Ford as a smaller example for somebody that wants to try this out but does not have the capital to put it in. Ford's a great segue because it's, again, a automotive company and it's much, much smaller. Ford right now, making this video, is trading about $12.84. Let's say, based on our technical analysis or any other metric, we want to buy Ford at $11. So these are, again, out of the money puts. Right now, you're only going to get about 19 cents or $19. Now, that doesn't sound like much, but again, the cost to take on the shares, the cost that we need in our account is going to be for an $11 share price times 100, $1,100. So the buying power effect that we would need to put this on is going to be $1,081. So much smaller. It's much better for us testing the strategy, seeing if it works for us. And the math works out the same. Basically, if we sold the put, we would credit 19. The cost of 100 shares would be 1,100 that we need to make sure is in our account. And then, of course, if we got a sign, we got the shares basically $19 cheaper. than $1,100. Again, purely hypothetical. If we sell the put this month, we can credit about 14 after we've done our 75% or 15 days to expiration close. Do the next month, stock goes up, we get a little bit less. We only take about $11. May, stock goes down, we are able to capture a little bit more. So after 3 months, we've made roughly close to $50. Based on $1,100, which was our cash outlay, we return roughly about the same amount, about 4.5%. And you can think about that in annualized terms. Again, we should be able to get double-digit return on our cash sitting there waiting to buy a stock. Ford at $11. Now, there's one thing that you can do, but I don't think you should. But I want to show it just in case you want to be really risky. I do not recommend this at all. On some platforms, what I'm showing you right now is Tastyworks. Some accounts you can get a margin account where you can actually sell options on margin. It's dangerous because you're basically taking out leverage. If you look down here, the max loss on this is still about $47,000, even if we sold it for $950. But the buying power effect, the margin that we would have to put up is less than $10,000. So you could actually do this with a $10,000 account, not a $50,000 account. But I don't recommend it because if the stock price goes down below 480, you won't be able to buy those shares because you just don't have the money in your account. You would have to just take a loss at that point. They would probably automatically close it before you got to your full buying power because they're not going to let you go negative. Or actually you could and owe them money. So again, another reason why this is not safe to do. I don't recommend this, but it is out there if you wanted to do margin. But we're talking about cash secured because that is the strategy for I want to own the shares, not I want to put myself in the event of a loss. So bear that in mind. So again, with Tesla, I'm being patient. I want the market to come to me. I want it to come to the level that I'm looking at. Little bonus here, going back to Ichimoku, which I've talked about on the weekly. If Tesla does come down to this level, that weekly cloud is going to be that 50% level that I'm looking at. So I am watching this as if it is a bearish pullback to the long-term bull trend of Tesla. And 480 is where I'm going to start to get really interested. But in the meantime, I'm going to be looking at these puts. Be safe, be smart with your capital, guys, and trade wisely. We'll see you in the next video.